Many of us live in a cycle that, in simple terms, looks something like this. Because we don't have enough money, we work to earn it. But before we know it, the money is gone. Then we go back to work just to pay the bills, repeating the same cycle over and over again for the rest of our lives. But you may be wondering, how can someone break free from this cycle if most people spend their entire lives working just to pay this month's bills? Dave Ramsey's book, The Total Money Makeover, presents a straightforward plan to change that reality. His philosophy is based on making sacrifices today in exchange for financial freedom tomorrow. That's why the book's famous motto is, "Live like no one else today, so later you can live like no one else." The first step is accepting responsibility for where you currently stand financially. You must understand that if your own decisions led you into this situation, then your own decisions will also be the ones that lead you out of it. So what exactly is Dave's plan? Before anything else, you must completely eliminate denial. Stop convincing yourself that your financial situation isn't that bad, or believing that buying what you want with another loan or by paying only the minimum credit card payment is somehow a solution. Simply getting by without ever taking control of your money should never become your normal way of living. If you continue doing this, you're allowing money to control you instead of the other way around. Whenever you have a little extra cash, you immediately spend it. Whenever you have available credit, you immediately use it. Without limits, without discipline, without even thinking about the long-term consequences. Many people aren't doing well financially, yet they still buy brand new cars, expensive clothes, luxury vacations, and countless other things simply to impress their friends and family, even if it means piling up credit card balances and loans. Believe me, this is far more common than most people realize. The first thing we need to understand is that debt is not a financial tool, unless you're a large business owner managing massive amounts of capital. For the average person who hasn't yet built significant wealth, debt is simply a financial setback. It's a way of buying things you cannot actually afford. Debt includes credit card balances, personal loans, financing agreements, monthly installment payments. In short, it's everything you buy today with money you promise to earn months, or even years, from now. Dave Ramsey strongly opposes the use of credit cards because they're the #1 reason people fall into debt. Most people simply don't know how to use them responsibly. I used to misuse credit cards myself, which is why today I avoid them almost entirely and pay for nearly everything in cash. The only time I use a credit card is when it's absolutely necessary, such as paying for an online subscription or a similar service. More importantly, we must completely abandon the myth that debt is somehow good, or that using credit cards is beneficial because you earn reward points. That's exactly what banks want you to believe. Reward programs are designed to encourage you to spend even more money using your credit card. Dave makes an excellent point. No one has ever become a millionaire because of credit card reward points. People become wealthy by increasing their income, living below their means, and only spending money they actually have. A perfect example is buying a car. Many people start earning a little extra money and immediately think, now I can finally buy a brand new car. So they finance it over several years, believing they've found a great deal. Dave strongly disagrees. Instead, he recommends buying a reliable used car and saving enough money to pay for it in cash. When you pay cash, you can often negotiate a better price and avoid paying thousands of dollars in interest. It's far better to spend time saving for a dependable used car than to finance a brand new one that will ultimately cost almost twice its original price by the time you've finished making all the payments. Of course, following Dave's plan isn't easy. One of the biggest challenges is dealing with the opinions of other people. Friends may question your decisions. Family members may not understand why you're driving an older car or saying no to expensive vacations. But Dave reminds us that our focus shouldn't be on earning other people's approval. It should be on achieving financial freedom. He also makes another important point. The earlier you begin this journey, the better. If you're still a teenager or in your early 20s, you'll reach financial independence much sooner than someone who waits until adulthood after accumulating years of debt. Debt is not a wealth-building tool. It's a system that enriches banks while keeping ordinary people financially trapped. Your greatest wealth-building tool isn't debt. It's your income. When you consistently increase your income, spend less than you earn, and invest the difference, you begin creating real wealth. That's the central message of the book. Another lesson Dave emphasizes is to avoid chasing easy money. Quick rich schemes usually lead people into scams, bad investments, and costly mistakes. Instead, focus on what actually works. If you want to earn more money, find ways to increase your income. Start a side hustle. Launch a small business. Develop valuable skills. Take on additional work if necessary. Anything that allows you to earn more each month is moving you in the right direction. But no matter how much more you earn, don't spend it all. Save part of it. Invest part of it. Allow your money to begin working for you. And never stop learning about personal finance and investing. Because what you don't know about money is often exactly what keeps people broke and buried in debt. With that understanding, it's time to begin Dave Ramsey's Total Money Makeover plan. Step 1. Save your first $5,000. Start small. Build momentum. As Dave himself explains, just as it's impossible to lose 20 pounds of body fat in a single day by running and lifting weights, it's equally impossible to achieve financial health overnight. Think of yourself as the CEO of a company called You Inc. Every successful company operates with a budget. You should too. Create a monthly budget that clearly defines how much money comes in, how much you spend, how much you save. If your budget is too tight to make meaningful progress, look for additional sources of income to speed up the process. But why is saving your first $5,000 so important? Because this becomes your starter emergency fund. Life is unpredictable. Unexpected expenses happen to everyone. Having emergency savings means you won't have to rely on debt whenever something goes wrong. I experienced this personally when my dog became seriously ill and needed surgery that cost $1,200. Instead of putting the expense on a credit card and paying interest for months afterward, I already had emergency savings available and simply paid for the surgery in cash. That's exactly why you should begin building your emergency fund today. Whether you lose your job, face an unexpected medical bill, or deal with any other financial emergency, you'll be prepared. It's time to break the cycle of earning money only to spend every dollar you make. Reduce unnecessary expenses, work extra hours if needed, find new income opportunities. Reach this first milestone as quickly as possible so you can move on to the next step. Step 2. Pay off all your debt. Now it's time to eliminate every debt you have. Take a notebook or a sheet of paper and write down every single debt, starting with the smallest balance and ending with the largest. The only exception is your mortgage, if you have one. That will be handled later in the plan. Dave Ramsey calls this strategy the Debt Snowball Method. Why start with the smallest debt instead of the one with the highest interest rate? Because personal finance is more about behavior than mathematics. Every time you completely pay off one debt, you experience a small psychological victory. That feeling of progress builds confidence and motivates you to keep going. For example, paying off a $50 debt won't dramatically change your financial situation if you still owe $10,000 overall. However, it changes something even more important: your mindset. You begin believing that becoming debt-free is actually possible. After paying off the $50 debt, you'll feel motivated to eliminate the next one, perhaps a $350 balance, then the next, and the next. Eventually, one by one, every debt disappears. While you're aggressively paying off your smallest debts, Dave recommends continuing to make the minimum payment on all your larger debts. This prevents late fees and additional interest from causing your balances to grow even faster. Depending on how much debt you've accumulated, this stage may require serious sacrifice. You may need to work overtime, pick up a second job, drive for a rideshare company, freelance on weekends, sell items you no longer need. The harder you work during this season, the faster you'll become debt-free. Dave also recommends waiting until you've saved your initial $5,000 emergency fund before attacking your debt. That way, if an unexpected expense occurs, you won't be forced to borrow money all over again. Remember, that $5,000 is not spending money. It's reserved strictly for real emergencies. Once every debt, except your mortgage, is completely paid off, you're ready for the next step. Step 3. Fully fund your emergency fund. Now that you're debt-free and still have your initial emergency savings, it's time to expand that fund into a complete financial safety net. Your goal is to save enough money to cover 3 to 6 months of your living expenses. For example, if your monthly expenses are $2,000, your fully funded emergency reserve should contain between $6,000 and $12,000, depending on your situation and comfort level. Yes, That may sound like a lot of money, but emergencies don't ask for permission before they happen. If you're financially prepared, an unexpected event becomes an inconvenience instead of a disaster. Without savings, however, most people immediately return to credit cards and loans, which puts them right back into the cycle they're trying to escape. That's why it's essential to distinguish between a true emergency and a simple desire. A real emergency includes situations such as losing your job, a major medical expense, a serious car repair, replacing a broken phone that you genuinely depend on for work. These are unexpected events that threaten your financial stability. Buying the newest smartphone because it's just been released, taking an unplanned vacation, or shopping during a sale. Those are not emergencies. Your emergency fund should never be used for unnecessary purchases. Otherwise, you'll never finish building it. Dave also recommends keeping this money somewhere safe and easily accessible. This isn't money you're trying to grow aggressively. It's money designed to protect you. That means your emergency fund should not be invested in stocks or other volatile assets. Instead, keep it in secure, highly liquid investments or savings accounts where you can access it quickly whenever you truly need it. The purpose of this money isn't to generate wealth. Its purpose is to provide peace of mind. Interestingly, as your financial discipline improves and your emergency fund grows, you'll probably find yourself needing it less and less. At first, you might look at your savings and think, wow, I have $5,000 sitting there. Maybe I should buy that new $1,200 phone that just came out. But over time, something changes. And your desire to achieve long-term financial security becomes stronger than the temptation to spend impulsively. According to Dave Ramsey, reaching this point, becoming debt-free while building a fully funded emergency reserve, typically takes between 24 and 30 months for people who remain consistent and committed to the plan. Step 4. Invest 15% of your income. By the time you reach this stage, you'll already belong to a very small percentage of people. You'll have no consumer debt. You'll have a fully funded emergency fund. And most importantly, you'll finally have financial peace. Now it's time to put your money to work. From this point forward, Dave Ramsey recommends investing 15% of your gross income every single month. Notice that this step is not about getting rich overnight. In fact, it's the exact opposite. Real wealth is built through patience, consistency, and discipline. It's the habit of investing month after month, year after year, regardless of what's happening in the economy. Dave compares this approach to the famous story of the tortoise and the hare. The tortoise wins not because it's faster, but because it never stops moving forward. Investing works exactly the same way. Don't spend your life chasing the next hot investment or trying to double your money in a few weeks. Become a genuine long-term investor, not a speculator. There's a beautiful analogy that illustrates this idea. When we plant a rose seed, we don't criticize it because it doesn't yet have roots, leaves, or flowers. We understand that it's still in the early stages of becoming something beautiful. Investments work the same way. At first, your portfolio may seem small. Growth may appear slow. But if you continue investing consistently, time becomes your greatest ally. The objective is to invest in quality assets capable of generating steady returns over many years, without taking unnecessary risks during this stage of your financial journey. That's why education is so important. Before investing your hard-earned money, take the time to study. Understand how investing works. Learn about risk. Learn about diversification. The more knowledge you acquire, the better your financial decisions will become. Step 5. Pay off your mortgage. The next milestone is eliminating the largest debt most people ever have, their mortgage. Dave's philosophy is simple. The lower your monthly expenses, the easier it becomes to build lasting wealth. Every mortgage payment represents money that can no longer be invested for your future. Imagine if, instead of sending that payment to the bank every month, you could invest it. Over time, that difference becomes enormous. So how do you pay off your mortgage faster? The answer hasn't changed. Continue following the same habits that brought you this far. Stick to your monthly budget. Reduce unnecessary expenses. Increase your income whenever possible. Look for additional ways to earn money. No, it won't happen overnight. Dave Ramsey says that, after working with thousands of families as a financial coach, the average person who follows this plan pays off their mortgage in approximately 7 years. It requires patience. It requires discipline. But the reward is extraordinary. Imagine owning your home completely. No monthly mortgage payment, no debt hanging over your head, just complete financial freedom. Step 6. Build wealth and give. This is where all your hard work begins to pay off. Now your primary focus shifts toward growing your investments. As your portfolio continues to grow, you'll begin experiencing one of the most powerful forces in finance: compound interest. Unlike the interest you pay on debt, which takes money out of your pocket, compound interest works in your favor. Your investments begin generating returns. Those returns then generate even more returns. Over time, your money starts earning money on the money it has already earned. This creates a snowball effect. The earlier you begin investing, the more time compounding has to work its magic. That's why Dave encourages reinvesting your investment earnings instead of spending them. Every dollar you reinvest becomes another employee working for you 24 hours a day. But after all this effort, why build wealth in the first place? Dave believes wealth serves three important purposes: to enjoy, to invest, and to give. There's nothing wrong with buying your dream car, owning a beautiful home, traveling the world, or purchasing the things you've always wanted. The key is buying them at the right time, when your investments are producing consistent income rather than relying on debt. Investing allows your wealth to continue growing long after you've stopped working. Eventually, something remarkable happens. Your money begins earning more than you do, and that's the moment you achieve true financial independence. Money never sleeps. It keeps working around the clock. That's one of the biggest reasons wealthy people continue becoming wealthier. Finally, there's one last purpose for wealth: giving. Generosity is one of the greatest rewards of financial success. Being able to help others, support meaningful causes, improve someone else's life. Those opportunities become possible when you've built financial security. As Dave Ramsey often reminds us, money doesn't change who you are, it simply magnifies who you've always been. If you're selfish, wealth may make you even more selfish. But if you're generous, wealth gives you the ability to become extraordinarily generous. And ultimately, that may be the greatest return on investment of all.